Hello, my name is Breon Mills and welcome to my channel. Mutual funds, index funds, and ETFs are great ways to invest your money over the long term. Today I'll explain each fund, some of the pros and cons, and leave you with a better understanding of the three so you can make the best investments for you and your future. How does that sound? In the 1970s, mutual funds began to rise as one of the more popular forms of investing. When investing in mutual funds, you transfer your money to the broker. The broker would take your money and put it into a fund. Now think of it as one big basket of stocks. And this basket or mutual fund consists of, on average, 40 to 90 different stocks across all sectors of the market. Mutual funds are managed by a mutual fund manager. This fund manager makes all these promises. They will tell you that it's much better to own mutual funds, and they will grow your funds and build a nice nest egg for you. And for the most part, he's true. He will make more money in mutual funds than you will having your money in a savings account. It's a nice hands-off approach. You just send your money, and all you want him to do is to continue to make you money. But what isn't shared with you is the overall cost of doing business with the fund manager. When it comes to mutual funds, there are hidden fees wrapped up in complex verbiage that most people don't understand. Let's take a look at some of the fees. The first fee is a management fee. On average, the management fee is 1%. This fee alone is the reason why fund managers are the nation's top earners. Think about it for a second. 1% of $250 million, which is a small fund, is $2.5 million a year for the fund manager. Next is the broker's fee, which is usually 5%. You invest $1,000, the broker gets $50, and $950 goes into your fund. Next up is the purchase fee. This is an upfront payment that goes to the fund, not the broker. Then next up is the annual fee or the expense ratio. You pay an annual fee to operate the fund. Next up is the distribution fee. These are fees used to promote and market the fund. But last but not least is the maintenance fee. You may be charged a maintenance fee if your balance falls below a certain dollar amount. Now, that's a lot of fees just for wanting your money to grow. Over a 20-year period, the average person can pay anywhere from $20,000 to $100,000 just in fees alone. And research has shown repeatedly that fund managers simply aren't able to beat the market on a regular basis. And it really doesn't matter to them. They are paid regardless. Their number one goal is to find new business. The more money in the pot, the more money they make. If a fund manager can find 10 to 15 people per year to transfer their retirement funds to him, that's guaranteed money earned. That's an extra 6 figures to a salary. But again, if you want a hands-off approach, you just want your money to grow a little, mutual funds beats a savings account. Next, we have index funds. To understand index funds, we first must understand what is an index. An index is used to represent and communicate the performance of the stock market or part of it. There are many indexes, but some of the more commonly known indexes are the Dow Jones Index, the S&P 500, and the NASDAQ Composite. Now, the Dow Jones Index represents the 30 largest companies in the U.S. The S&P 500 represents the top 500 companies in the U.S. And the NASDAQ Composite represents 3,000 companies traded on the NASDAQ exchange. Now, index funds allow you to invest in these indexes at a fraction of the cost versus buying each individual stock. If you take a look at the Dow Jones Index, it is composed of 30 companies. Over the past 100 years, the Dow has consistently gone up. You can mimic the Dow by purchasing only one share of stock from all 30 companies for around $3,700, or you can purchase an index fund for anywhere between $20 to $200. It owns the same stocks and it moves in the same direction as the Dow. Unlike mutual funds, index funds are passively managed funds. You won't have someone trading or overseeing your account. All right? You make all the decisions, which means lower fees. The only fee you will have is an operating fee or an expense ratio. And the average cost is around 0.12%. And that's it. With Fidelity, there are some index funds where there is no expense ratio fee. You simply pay the cost to purchase that index fund. At Fidelity, it's $4.95. Now that's hard to beat. Now, index funds are better to people who are slightly more knowledgeable of the market, but has no plans on full-time trading. If you want your money to grow and you want to ride the wave of the market, index funds may be a good choice for you. ETFs, or exchange transfer funds, are a basket of stocks offering much more versatility than index or mutual funds. They are bought and sold just like a stock. This basket of stocks, or ETFs, come in all shapes and forms and varieties. There are ETFs that track the market, that track bonds, that track commodities like gold, beef, or even corn. They are sector-specific ETFs. You can invest in the financial ETFs, industrial ETFs, foreign markets, technology, etc. There are thousands of ETFs that you can invest in. You can trade them daily, swing trade, or hold long term. The choice is yours, just like a regular stock. With ETFs, the goal is not to always beat the market. Now, if I own ETFs in one sector, say the industrial sector, as long as the industrial sector is doing well and providing consistent positive returns of my liking, I'm satisfied. When an ETF is tied to a sector and deliver consistent and profitable rate of return, there's less pressure to pick one right stock. So choosing the right ETF in the right market or the right sector can deliver consistent positive returns on your investment. Now let's take a look at a few funds.
When doing your research on mutual funds, index funds, or ETFs, once you go to the website, the first thing that will come up is the performance or the snapshot of the fund or index. What we have here is the Fidelity Growth Company Fund. Now, if you take a look at it, it gives you the overall rating, which is 5-star, returns, rate of return, which is high, the expenses, the risk category, the year-to-date return, 5 years return, 14.12%. Also gives you the details. It's large growth stock, the expense ratio, the average price of the stock. Also over here in the center, it gives you a detail to, whereas if you would have invested $10,000 into this company 10 years ago, where would your money be today? So if you would have invested $10,000 into this Fidelity Growth Fund in 2009, that investment would be $54,572 today. Again, that is a good return on your money. All right. Also, on the fund, on the snapshot, you will see the top 10 holdings. And so the top 10 holdings are actually 39% of the total portfolio. So the top 10 holdings here: Nvidia, Amazon, Apple, Google, Salesforce, Microsoft, Facebook, Lulu, and Google. Again, some great companies. You can see it's tech heavy, so they are really invested in the technology sector, because the technology sector does grow pretty fast. compared to the rest of the market. Whether it's a mutual fund, ETF, or index fund, whenever you go to the website, the fund's website, and you pull up the fund, you will be provided with this type of snapshot. All right, take a look at your fees, take a look at the 1-year chart, 5-year chart, take a look at the history of this stock and see how it's performing, and use this information to hopefully make the best decisions for you in your future. Okay? Thanks, and I appreciate the love.
Hey, look, you could have been anywhere in the world, but you're here with me, and I appreciate that. Like, share, subscribe, and come on back for more wealth building information. Peace.